Welcome back to Talk Tickers. So today's deep dive is going to get into a dominant consumer brand, one that's operating in probably the most explosive, culturally relevant category in food and beverage right now.
Oh, absolutely. The protein market is just on fire.
Right, the protein market. So we're looking at BellRing Brands today, ticker BRBR, and they just reported their Q1 2026 quarter. And the numbers, they pulled down $500 million in revenue.
Which is massive.
It is. They completely shattered their own internal revenue estimates. So by all conventional logic, this stock should be taking a victory lap.
You'd think so, yeah.
And this is why we do what we do for you, the retail investor.
Yeah.
You look under the hood of this earnings call and you see consumption actually dropping on their core product. You see gross margins getting absolutely crushed by inflation and tariffs.
Yeah, it's a bit of a mess under there.
Totally. And you see these aggressive competitors just buying up shelf space. And then, to top it all off, there's this bombshell announcement tucked right into the prepared remarks.
Right, the CEO transition.
Exactly. The visionary CEO who basically built the company is walking away. So our mission today, the multi-billion-dollar question we're answering for you is BellRing a healthy, dominant growth story that's just taken a quick pause?
Or is this a stock that is just run way too fast for way too long and is finally running out of breath?
Exactly. That is the question.
It's really the ultimate diagnostic challenge right now because the headline numbers they just reported for Q1, they tell a story that is completely disconnected from the physical reality happening in grocery store aisles.
There's a massive disconnect.
A huge one. You have this gap between what the algorithms are trading on today and what the actual supply chain is doing.
Okay, so let's start right there. Let's get data forward to unpack this. So BellRing generated $537 million in Q1 net sales, which is up 1% year over year.
Right.
And on its face, 1% growth sounds pretty stagnant. But in the context of Wall Street expectations, management actually framed this as a massive beat.
Yeah, because they guided the street to expect a 5% decline in sales this quarter.
Right. So going from a projected negative 5% to a positive 1% on over $500 million in revenue, that is a colossal swing.
It really is.
And it flowed down to a very healthy adjusted EBITDA of $90 million, which gives them a 16.8% margin.
Which, that looks fantastic on a Bloomberg terminal. A 16.8% operating margin on a consumer packaged good. That is highly robust.
That sounds great.
It does. But aggregate numbers, they always obscure the friction underneath. And BellRing is essentially two completely distinct businesses running in parallel.
Right.
You have Premier Protein, which is the mainstream ready-to-drink liquid shakes, the anchor of the company.
Yeah.
And then you have Dymatize.
The powder brand.
Exactly. The powder brand targeting, serious athletes and gym goers.
And the performance of those two brands this quarter, it looks like they exist in completely different economies.
Oh, totally.
Because Premier Protein's net sales were actually down 1%. But even more concerningly, if you isolate just the ready-to-drink shakes...
The RTDs?
Yeah, the RTDs, like those 4-packs you see at Target, actual consumption of those was down 2%. Meanwhile, Dymatize surged 16%.
Driven almost entirely by international volume, too.
Right. So wait, let me get this straight. If the core product making up the lion's share of the business is down 2% in actual consumption, but overall sales are up 1% when they expected a 5% drop.
Yeah, the math feels weird.
It feels like getting my paycheck a week early.
Right.
Like my checking account looks fantastic on a Wednesday, but I didn't actually get a raise. I didn't earn more money. The timing just shifted. Are we basically just looking at an accounting illusion here?
Your paycheck analogy is the exact right framework for this. CFO Paul Rhodes, he addressed this head on in the call.
What did he say?
He attributed the top line beat primarily to, quote, a timing benefit from customer orders.
A timing benefit.
Yeah. So the orders that BellRing fully expected massive retailers to place and fulfill in the second quarter, they were simply shifted forward into the first quarter.
Okay, I always look at that phrase timing benefit with intense skepticism. It just feels like corporate spin to me. Why would a massive logistics machine like Costco or Walmart just decide to order millions of dollars of protein shakes 3 weeks early?
Well, it comes down to the brutal, hyper-optimized mechanics of retail supply chains. You have to remember, BellRing doesn't sell to you and me directly.
Right, they sell to the warehouses.
Exactly, mammoth logistics networks. A buyer at Sam's Club or Kroger, they are constantly running complex algorithms, balancing their warehouse footprint, trucking capacity, promotional calendars, all of it.
So it's all automated?
Mostly, yes. So if Kroger suddenly has, say, excess pallet space in a regional distribution center in late December, or, maybe freight costs dip momentarily.
Their system just triggers an order.
Exactly.
Yeah.
Their system automatically pulls forward purchase orders that were planned for January. And the second that pallet of Premier Protein leaves BellRing's loading dock and arrives at Kroger's facility.
BellRing gets to recognize the revenue.
Right. That becomes a net sale on the books.
Which highlights probably the most dangerous trap for retail investors looking at consumer goods. The difference between sell-in and sell-through.
Oh, absolutely.
So sell-in is BellRing pushing boxes into the Kroger warehouse. But sell-through or consumption is an actual human being taking a 4-pack off the shelf and swiping their credit card.
And that 1% top line growth, that was purely selling. It was just supply chain Tetris.
Wow. Supply chain Tetris.
Yeah, because the actual human consumption of Premier liquid shakes was down 2%. The product was moving faster into the warehouses than it was moving out of the actual store doors.
That's a huge red flag.
It is. And Rhodes essentially admitted that this is a zero-sum game. The revenue that was pulled into Q1 leaves a vacuum in Q2.
Okay, so the headline beat is basically a mirage. If consumption is dropping 2% for a brand that is supposed to be riding this unstoppable cultural wave of high-protein diets, we really need to look at what's bleeding them on the store floor.
Yeah, we do.
And according to management, the bloodiest battleground right now is the club channel. We're talking Costco, Sam's Club, BJ's.
Right. And the club channel is a completely unique beast. The unit economics there can literally make or break a brand.
How so?
Well, in a standard grocery store, you have maybe 20 linear feet of shelving dedicated to 15 different protein brands. The consumer has endless choices.
Right.
But in a club store, a brand isn't fighting for a few inches of shelf space. They're fighting for an entire pallet position right on the floor.
Oh, wow. So it's winner take all.
Exactly. The club retailer heavily curates the assortment, so they only carry a few select brands. If you secure a pallet spot, you move astronomical volume. But if you lose it...
Your regional numbers just crater overnight.
Overnight, yes.
And Premier's 2% consumption drop is heavily concentrated in those club channels right now. Now, to be fair, management defends this by pointing to the comps.
The comparables, yeah.
Right. They were lapping Q1 of last year, where Premier saw 23% consumption growth in clubs.
Which is insane.
Lapping a 23% growth quarter is basically trying to beat your own world record.
It's almost impossible.
But they didn't just blame the math. CEO Darcy Davenport explicitly called out an unexpected surge in promotional aggression from what she termed insurgent brands inside the clubs.
Yeah, that phrase, insurgent brands, it paints a very specific picture of the current food and beverage landscape.
It sounds like warfare.
It is. It's the guerrilla warfare phase of a product cycle.
Yeah.
Historically, just look at what happened in the energy drink space a few years ago.
Oh, right.
You had the established giants like Monster and Red Bull, and suddenly you had these VC-backed insurgents like Bang Energy or Ghost coming in and just completely disrupting the shelf space.
And management is arguing that a similar dynamic is happening in the club protein space right now.
Precisely. These smaller, younger competitors are engaging in highly irrational economic behavior just to steal market share.
Irrational meaning they are basically just lighting venture capital money on fire to get my attention as a shopper.
Fundamentally, yes. I mean, to break into a Costco, an insurgent brand can't just rely on organic discovery. They have to pay exorbitant slotting fees.
Right.
They have to pay for end cap displays, which is that highly visible real estate at the end of the aisles. And most expensively, they have to fund the demo stations.
Oh, the sample ladies.
Exactly. Hiring brand ambassadors to stand there on a busy Saturday, handing out tiny paper cups of protein shakes, that is a massive capital expenditure.
And they're probably discounting the price too.
Heavily. Add deep price discounting on top of the demos, and these insurgent brands are likely operating at a severe loss. Or at best, razor-thin margins.
They're subsidizing my purchase just to build brand awareness. It's the classic customer acquisition cost strategy. You buy the user today, and you just hope they stick around tomorrow. But from BellRing's perspective, this has got to be a massive headache.
Oh, it is.
If an insurgent brand is $1 cheaper per shake, and they're giving out free samples, some marginal Premier consumers are going to defect.
They will. But management seems convinced this is just a temporary, quote, sugar rush for these competitors.
Yeah.
They believe it's completely unsustainable.
Because eventually, the venture capitalists funding that cash burn demand profitability.
Exactly. The promotional spigot gets turned off, the free samples stop, the price goes back up to parity with Premier.
And when that happens,
Retail buyers look at one metric and one metric only: baseline velocity.
Meaning how fast the product moves when it's not on sale.
Right. How fast does it move when it's not being artificially propped up by discounts? Management's thesis is that these insurgents just don't have the underlying brand equity to maintain velocity.
And Costco is ruthless.
Oh, Costco is incredibly ruthless. Once the velocity drops, they will revoke that pallet space and give it right back to the proven anchor tenant.
And Premier is undoubtedly the anchor tenant in this space. They hold a dominant 22% market share in the category.
They have massive household penetration, high repeat purchase rates.
So the argument is, let the insurgents bleed out their cash. We will take a temporary hit to volume, but we will reclaim the space when the dust settles.
It's a logical defense.
It is. But lost volume isn't their only problem. The margin profile of this business is under severe attack from multiple angles right now. Gross margins are getting crushed, and the biggest culprit they mention is whey protein.
Yeah, whey commodity cost inflation is peaking right now.
Yeah.
And to really understand why this hurts BellRing so badly, we have to look at the mechanics of the dairy supply chain.
Okay, break that down for us, because I think a lot of people just think of it as powder in a tub.
Right. So whey is actually a byproduct of cheese manufacturing.
Oh, interesting.
Yeah, the liquid that separates from the curds during the cheese making process.
Yeah.
That gets refined, filtered, and dried into whey protein isolate or concentrate.
Okay.
So the global supply of whey is highly inelastic. You can't just decide to build a new whey factory overnight. Supply is entirely dependent on global dairy herds and international cheese demand.
So when supply tightens, the spot price of whey spikes dramatically.
Exactly.
Which explains the massive divergence in the profitability of their two brands. We established that Premier RTDs are down, but Dymatize powder is up 16%.
Right.
And on paper, 16% growth looks great, but Dymatize is essentially just concentrated whey powder in a plastic tub.
It creates a really vicious margin mix. Think about it. A ready-to-drink Premier shake is mostly water.
Right.
It has flavorings, stabilizers, packaging, and the protein component. So the cost of goods sold is diversified.
Oh.
But Dymatize, it is entirely exposed to the whey commodity market.
Wow.
So when whey prices surge, the gross margin on a tub of Dymatize just collapses.
So BellRing's fastest growing segment this quarter was simultaneously their least profitable segment due to input costs.
Exactly. It drags the consolidated margin of the entire company down.
And they can't just eat those costs forever. Management noted they're executing pricing actions on Dymatize to offset the whey inflation, basically passing the cost to the consumer.
Right, but that triggers elasticity models. They know that if they hike the price of a tub of Dymatize by 10%,
a certain percentage of casual gym goers will just trade down.
Right, they trade down to a cheaper brand, or they just stop buying powder altogether.
Yeah.
So management is openly modeling for demand destruction in the second half of the year because of these price hikes.
It's a delicate balancing act, protecting margins versus protecting volume. And just as they are fighting this whey inflation battle, geopolitical reality hands them another permanent bill.
The tariffs.
Yes, the CFO noted that tariffs ate 75 basis points. So that's 0.75% of their gross margin this quarter. And they expect tariffs to create an 80 basis point drag for the full year.
Now, for retail investors, 80 basis points might sound like a rounding error.
Right, less than 1%.
But when you are operating a business generating $2.4 billion in annual revenue, almost a full percentage point of pure profit wiped out by import taxes is a multi-million-dollar structural blow.
Because you can't outmarket a tariff.
No, you can't.
You can't innovate your way around an import tax on raw materials. It's just cash extracted directly from the bottom line.
It fundamentally resets their baseline profitability lower, unless, they can find massive operational efficiencies elsewhere in the supply chain, which is incredibly difficult in a mature manufacturing network.
So we have a war on three fronts here. Insurgents attacking volume in clubs, whey inflation crushing powder margins, and tariffs acting as a permanent tax on the whole operation.
It's a lot.
It is. But what really stood out to me in the transcript was that not all their wounds were inflicted by outside forces. They actually shot themselves in the foot this quarter with a major execution failure at retail.
Oh, the mass retailer merchandising delay.
Yes. Management admitted that Premier's Q1 consumption missed their internal targets, largely because of a delay in activating a massive promotional display at a major mass retailer.
And in the consumer packaged goods space, mass retailer is almost universally code for Walmart or Target.
Okay, I have to push back on this. How does a multi-billion-dollar operation allow this to happen? To a layman, hearing that consumption targets were missed because someone was late setting up a cardboard display, it sounds absurd.
It does sound silly.
Right. How does a delay like that materially impact a publicly traded company's quarter?
Well, it requires understanding the specific psychology and the physical reality of the new year, new you merchandising transition.
Okay.
Think about a Target store on December 26th. The store is completely optimized for holiday consumerism. Massive footprints dedicated to wrapping paper, toys, heavy comfort foods, baking supplies.
Totally.
But literally overnight, the retailer has to execute a monumental physical reset. They tear down the holiday aisles and replace them with storage bins, fitness equipment, and wellness supplements.
January 1st is basically the Super Bowl for the diet and protein industry.
Exactly. Millions of consumers walk into these stores with fresh resolutions. Now, BellRing had negotiated premium multi-point disruptions for this exact window.
Disruptions meaning like displays outside the normal aisle?
Right. We aren't just talking about their normal spot in the pharmacy aisle. They had negotiated massive pallet displays near the grocery section, end caps near the checkout, standalone towers.
The goal is to interrupt the shopping pattern.
Yes. Interrupt the pattern of a consumer who wasn't even actively looking for protein. Trigger the impulse buy based on their New Year's resolution and acquire a new customer.
But due to the complexity of the retailer's own internal transition from the holidays, the physical execution of getting those displays onto the floor was delayed by several weeks.
Which means they completely missed the peak of the resolution wave.
Oh, wow.
The highest intent buyers in the first 2 weeks of January walked right past empty floor space where Premier was supposed to be. When you model your quarterly projections on capturing that specific impulse traffic, a 2-week delay is a devastating hit to the consumption numbers.
But the data provides a really fascinating counterfactual here, because once the displays were finally built and fully active later in January, the demand metrics exploded.
The underlying consumer appetite is clearly still ravenous. Management highlighted that once the programming was in place, they saw strong double-digit consumption growth at that specific retailer.
Right. They logged record weekly sales on rollback items.
Yeah. January actually became their largest month ever at that mass retailer despite the delayed start.
And it buoyed the entire portfolio. Premier RTD consumption was up 6% across all channels in January. In fact, if you strip out the weirdness of the club channel insurgent war, consumption in mass, grocery, and drug channels was up an incredible 16%.
Which proves the demand isn't broken.
Exactly. It proves that when the physical product is actually put in front of the consumer's face, the conversion rate is massive. The execution broke, not the demand.
Which is a highly fixable problem going forward, but it really highlights how dependent even a dominant brand is on the operational competence of their retail partners.
Okay, so we've mapped the battlefield. We have massive underlying demand, but brutal margin pressures, vicious new competitors, and logistical headaches.
Yeah.
And right in the middle of navigating this incredibly precarious environment, the company drops a detail that completely alters the long-term thesis of the stock.
The transition of power.
Yes. CEO Darcy Davenport announced she is stepping down. She's retiring on or before September 30th, 2026.
And you simply cannot overstate how critical this variable is. When you buy a stock, especially a mid-cap consumer brand, you are heavily investing in the specific vision and operational capability of the leadership team.
Right. And Davenport isn't just some hired executive who bounced over from another conglomerate 3 years ago.
Not at all. She has been with this entity for 17 years. She explicitly noted on the call that when she started, it was a $20 million business. Today, it is a $2.3 billion global powerhouse.
She didn't just steer the ship, she built the hull.
Exactly. Institutional memory of that depth is an intangible asset. It never shows up on a balance sheet, but it dictates the survival of the company during crisis periods.
Absolutely.
Right? Think about the complexity of BellRing's model. They don't own their own manufacturing plants. They operate on a massive, highly complex co-manufacturing network.
Right. They contract third-party facilities across the globe to mix and bottle their shakes.
In managing those relationships, knowing which co-man has capacity, knowing how to negotiate whey contracts with dairy suppliers, understanding the nuances of the buyer relationship at Costco Davenport has 17 years of that embedded knowledge.
And she is walking away right at the exact moment when whey inflation is peaking, tariffs are hitting, and insurgents are attacking the clubs.
Yeah, the timing is, well, it's intense.
Now, to their credit, they are choreographing this to look as stable as possible. She is staying on for over a year to facilitate the transition, and she'll move into an advisory role afterward. They've initiated a national external search for her replacement.
But an external search inherently introduces massive execution risk.
Totally.
Bringing in an outsider is a severe roll of the dice. A new CEO might bring an aggressive M&A strategy or, find new ways to strip costs out of the business, but they also face a really steep learning curve in a market that just doesn't forgive hesitation.
Right. If the new executive misreads the elasticity of the Dymatize consumer,
or mishandles the club channel relationships,
the market share losses could compound rapidly. For retail investors, the CEO search is really the single most important non-financial metric you have to monitor over the next 18 months.
Absolutely.
So, with a legendary CEO on her way out, margins compressing, and the club channels under siege, we really have to evaluate what management is telling Wall Street to expect for the rest of the year. Let's break down the guidance, because there is a massive chasm between their short-term warnings and their long-term promises.
Yeah, the full-year outlook for fiscal 2026 paints a picture of a company transitioning from hypergrowth to mature stabilization. They narrow their net sales guidance to $2.41 billion to $2.46 billion.
Which implies top-line growth of roughly 4 to 6%.
Right. And that's perfectly respectable for a consumer staple, but it certainly isn't the rocket ship growth they experienced a few years ago. But the real story here is the profit margin guidance.
Tell us about the profit margin.
They project full-year adjusted EBITDA between $425 million and $440 million.
Okay.
Doing the math on the midpoints, that implies an EBITDA margin of about 18%. That is a direct 300 basis point contraction, a full 3% drop in profitability compared to the prior year.
Wow.
Yeah. The combination of whey, tariffs, and the promotional spending required to fight the insurgents is taking a permanent chunk out of their cash generation capability this year.
But if 18% for the full year sounds a bit tight, the guidance for the immediate future, the second quarter, is genuinely alarming. Management is practically begging Wall Street to brace for impact.
Yeah, they are.
For Q2, they are projecting sluggish 3 to 4% top-line growth, but they explicitly warned that Q2 EBITDA margins will plummet to roughly 13%.
A drop from nearly 17% in Q1 to 13% in Q2 is a cliff.
It is a cliff.
Management attributes this sudden compression to a convergence of negative factors hitting simultaneously. The way commodity costs are expected to peak precisely in Q2, the tariff impacts are fully modeled in, and most importantly, they are initiating a massive, purposeful spike in advertising expenditure.
Right. They are deliberately sinking massive amounts of cash into marketing right at the exact moment their input costs are highest. And this is where I start getting incredibly cynical as an investor reading these transcripts. Management essentially says, look, Q2 is going to be an absolute bloodbath. Margins will collapse to 13%. But don't worry, we promise that growth will magically accelerate and margins will expand in the second half of the year.
Yeah, we see this all the time.
We do. Aren't back half loaded forecasts just the ultimate Wall Street delay tactic? It's the corporate equivalent of saying the check is in the mail. How do we know they aren't just losing control of the fundamentals and buying themselves 6 months of breathing room?
It is the most vital question to ask when evaluating guidance. A back half loaded forecast is a massive red flag if the company's just relying on vague macroeconomic improvements, like hoping inflation goes away or hoping consumers suddenly feel richer.
Right.
But BellRing's defense of this guidance is actually highly mechanical. They aren't relying on hope. They're relying on 3 specific operational catalysts that they are putting into motion right now.
Okay, let's stress test those catalysts.
Right.
What is the lever they are pulling to save the second half?
So the first catalyst is the deliberate timing of that ad spend that is ruining the Q2 margins. In late December, they launched a massive omni-channel brand campaign called Go Get M.
It's a pivot in their messaging, right? Moving away from just targeting gym rats.
Exactly. Premier Protein has historically leveraged fitness-adjacent imagery. But Go Get M is designed to aggressively mainstream the brand. They are celebrating the everyday go-getters, nurses pulling 12-hour shifts, delivery drivers, parents managing chaotic households.
They're trying to position a 30-gram protein shake as a fundamental daily utility for normal people, not just a post-workout recovery tool.
Right. And to do this, they're spending heavily across linear television, streaming platforms like Hulu and Roku, podcasts, heavy social media integrations, and out-of-home advertising.
But if they launched this blitz in December, why is management claiming it's a catalyst for the second half of the year? Why aren't we seeing the sales spike immediately?
Because consumer packaged goods marketing operates on a pronounced lag effect. When you run a national brand awareness campaign, consumers don't watch a commercial and instantly drive to the grocery store.
Right.
Marketing at this scale is about building mental availability. It takes months of repeated exposure.
It's cumulative.
Yes. A consumer sees the ad on Hulu on a Tuesday, hears the podcast read on a Thursday, sees a billboard 3 weeks later, and then a month and a half down the line when they're finally walking down the wellness aisle at Target.
That accumulated mental availability triggers them to reach for the Premier 4-pack instead of a generic brand.
Precisely. Management is absorbing the financial hit of the ad spend in Q2, but the behavioral change, the actual register rings, won't materialize until Q3 and Q4.
Okay, I buy the mechanics of the lag effect. Ad spend is an investment in future behavior, not an immediate transaction. What is the second lever for the back half?
A heavy strategic focus on product innovation, specifically driven by single-serve formats to lower the customer acquisition cost.
Explain the economics of a single-serve bottle to me, because it seems like the margins would be worse than selling a bulk 12-pack.
The margin per ounce might be slightly lower, sure, but the strategic value of a single-serve bottle is immense. If a consumer has never tried a protein shake, they carry high hesitation.
Right. Asking them to spend $10 or $12 on a 4-pack of a flavor they might hate is a high barrier to entry.
Exactly. But if you place a cold $3 single-serve bottle in the refrigerated case right next to the checkout register, you reduce the barrier to entry to almost zero. It's an impulse trial. Management actually noted that single-serve sales in January were double what they were the previous year.
So they hook you with the low-risk single bottle.
Exactly. And Premier's strongest metric is their repeat purchase rate. Once a consumer realizes the shake actually tastes good, they return the next week and buy the high-margin 4-pack or 12-pack to stock their fridge.
So single serves are essentially paid sampling.
Yes. And they are combining this format strategy with aggressive flavor innovation. The standout right now is their Coffeehouse line.
Which feels like a direct attack on Starbucks to me.
Oh, it absolutely is. The Coffeehouse line features 30 grams of protein, but it also contains the caffeine equivalent of a full cup of coffee. They are targeting the morning energy and satiety occasions simultaneously.
And early data from the mass retailers shows that the caramel macchiato flavor was one of their highest velocity 4-packs in January.
Yeah, they're expanding it into the club channel later this month. They're taking share from the iced coffee market, not just the protein market.
And Davenport actually teased even more innovation. She mentioned 2 entirely new product platforms dropping in the second half. One is a higher protein formulation, which is likely designed to protect their flank from the serious fitness brands.
Right.
And the other was vaguely described as a completely different drinking experience compared to their core dairy-based shakes.
Which could mean anything. Clear protein waters, carbonated functional sodas.
And that mystery innovation ties directly into the third, frankly, most consequential catalyst they revealed.
The massive expansion of their total addressable market, or TAM.
This was subtly placed in their slide deck, but the implications are staggering. For years, BellRing defined the boundaries of their market as convenient nutrition. And under that specific definition, they calculated the total U.S. market size at roughly $21 billion.
And convenient nutrition is a highly restrictive, almost clinical definition. It evokes images of meal replacement shakes in a hospital or, chalky bars in a hiking backpack.
Right.
But management announced on this call that, based on extensive consumer research, they're officially redefining their category from convenient nutrition to wellness.
Wellness. I mean, it is the ultimate corporate buzzword, but in consumer packaged goods, it's a license to print money.
It really is. By simply shifting the definition to wellness, they instantly expanded their stated total addressable market from $21 billion to $24 billion.
That is a $3 billion expansion in theoretical market opportunity. But they can't just invent $3 billion out of thin air. How do they justify the math to the analysts?
The justification comes from studying cross-purchasing behavior. Consumers don't categorize their purchases the way Wall Street analysts do.
Right.
A consumer doesn't look at Premier Protein and only compare it to Muscle Milk or Ensure. They are comparing it to a much broader spectrum of functional beverages. The new $24 billion wellness category now explicitly includes hydration powders like Liquid IV, isotonic protein drinks, energy drinks, and functional sodas like Olipop or Poppy.
They are completely widening the aperture. They are no longer just competing to be the best post-workout shake. They're competing to be the default beverage you consume for your daily health optimization.
Exactly.
If I want protein and caffeine, I grab the Coffeehouse shake instead of a latte. If this new different drinking experience is a clear, fruity protein hydration drink, they're suddenly taking market share from Gatorade.
Precisely. The TAM expansion provides the strategic runway for the next decade of product development. It signals to Wall Street that BellRing hasn't hit a growth ceiling in the dairy shake aisle. They are just getting started in the much larger functional beverage arena.
Which brings us to the moment of truth. We have sifted through the mirage of the timing benefit revenue beat. We've examined the brutal margin compression from whey and tariffs. We've dissected the insurgent war in the Costco aisles, the massive risk of a CEO transition, and a back half strategy relying heavily on ad lag and a $24 billion TAM expansion.
It's an incredibly noisy, contradictory set of data points.
So what is the actual signal in all this noise? Here's the bottom line. Based on the complete synthesis of this Q1 earnings call, our stance is that BellRing Brands is a cautiously bullish hold for long-term investors, but you absolutely must expect significant, potentially violent near-term volatility.
Yeah, cautiously bullish hold perfectly threads the needle here.
Yeah.
The underlying architectural advantages of the brand, the 22% market share, the sky-high repeat purchase rates, the product innovation, are fully intact.
All right.
But the operational and macroeconomic headwinds over the next 6 months are incredibly severe.
So what is the actionable playbook for the listener? If you are managing your own portfolio, how do you trade this?
Well, if you currently hold BRBR in your portfolio, the paramount directive is do not panic when the Q2 earnings hit the wire in a few months.
Do not panic.
Exactly. Management has explicitly telegraphed that Q2 margins are going to crater to roughly 13%. The market is notoriously terrible at pricing in temporary, heavily telegraphed margin compression.
Algorithms and reactionary retail traders might trigger a sell-off because a 13% margin looks fundamentally broken compared to their historical mid-teens average.
But you have the deep context. You understand the mechanics. You know that 13% is the calculated result of peak whey commodity costs colliding with a massive, deliberate surge in go-get-M advertising spend designed to fuel the second half.
It's a deliberate transition quarter. You have to be willing to hold through the valley to get to the back half catalysts. But what if you don't own the stock yet? What if you are sitting in cash looking for an entry?
If you are considering initiating a position, patience is your greatest asset right now. Do not buy into the 1% top line beat from this quarter because we know that was just a supply chain timing illusion.
Let the Q2 reality hit the broader market.
Exactly. When those compressed 13% margins are officially reported, if the stock takes a disproportionate dip as we can sell off, that is your opportunity.
You buy in at a discount right before the advertising lag effect takes hold, right before the whey prices potentially stabilize, and right as the new product platforms launch into that expanded $24 billion wellness TAM.
That is the execution strategy. But to reinforce why you would want to own this in the first place, let's summarize the ultimate bull case. And it really rests on a massive, undeniable cultural tailwind that management only lightly touched upon. The GLP-1 effect.
Ah, yes. The proliferation of GLP-1 weight loss drugs like Ozempic and Wegovy is fundamentally restructuring the food and beverage landscape.
When millions of patients take these medications, they experience rapid, significant weight loss. But a known physiological side effect is the concurrent loss of lean muscle mass.
Right. And the medical community is responding by aggressively mandating high-protein diets for these patients to preserve muscle density during their weight loss journey.
It creates an enormous, incredibly sticky, medically incentivized demand curve for convenient protein.
Yeah.
If your doctor tells you that you have to consume 100 grams of protein a day while on this drug, you aren't going to cook 3 chicken breasts every afternoon.
No way. You are going to look for a convenient, palatable supplement. And Premier Protein is perfectly positioned as the path of least resistance. It isn't an intimidating, hyper-masculine bodybuilding tub of powder. It's a friendly, accessible, affordable shake you grab at Target. The GLP-1 tailwind could provide a floor for their volume growth for the next decade.
It is a phenomenal structural advantage. But the bear case demands equal respect because the risks are highly localized to BellRing's specific operational model.
Break down the bear case for us.
The bear case is essentially a war of attrition. First, the sugar rush of the insurgent brands in the club channel. Management assumes these VC-funded competitors will eventually run out of cash and disappear.
But what if they don't?
Exactly. What if private equity continues to fund them for 3 more years? That condemns Premier to 3 years of fighting margin-crushing promotional wars just to defend their pallet space at Costco.
And while they fight that war, the structural costs remain elevated.
Right. Whey costs are cyclical, but tariffs are structural. If geopolitical tensions continue to fragment global trade, that 80 basis point drag on their gross margins becomes a permanent feature of their balance sheet, permanently lowering their earnings ceiling.
And finally, the immense execution risk of the CEO transition. Darcy Davenport navigated the complexities of their co-manufacturing network and retail partnerships for 17 years.
Replacing a founder-level operator is notoriously dangerous. If the board misfires on the new hire, the entire execution of this new wellness strategy could derail right as the competitive environment is at its fiercest.
It is a high-wire act. They have arguably the right product, positioned perfectly in front of massive cultural tailwinds, but the literal business mechanics of producing that product and defending it on the shelf are becoming exponentially more difficult.
Which leads us to our final thought.
Yes, we always like to leave you with an angle to explore on your own. Something that wasn't explicitly spoon-fed to analysts on the call, but is the logical extrapolation of everything we've unpacked today.
The M&A horizon.
Exactly. Mergers and acquisitions. Put yourself in the boardroom of BellRing right now. You just expanded your theoretical playground to a $24 billion wellness category, explicitly targeting hydration, energy, and functional sodas.
Right.
You operate a highly cash-generative business, ending the quarter with a very comfortable net leverage ratio of 2.5 times. You have dry powder. You have money to spend.
Yeah, they do.
Meanwhile, you are watching all these smaller insurgent brands burn millions of dollars in irrational promotional spending just to get consumers to try their weird, new, clear protein waters or gut health sodas.
The insurgents are essentially conducting highly expensive, highly risky R&D and consumer trial work on BellRing's behalf.
Yes. So the provocative question is this. Will BellRing actually try to invent a protein soda or a hydration powder internally? Or, especially with the new, potentially aggressive CEO taking the helm, are we about to see BellRing go on a highly targeted M&A shopping spree?
I mean, why spend years and millions of dollars trying to formulate and market a new functional beverage from scratch when you can just wait for a startup to prove the concept?
Exactly. Let them build a loyal niche audience, burn through their venture capital, and then swoop in. You buy the surviving brand for pennies on the dollar, strip out their redundant corporate costs, and plug their product directly into your massive pre-existing national distribution network at Walmart and Costco.
It is the apex predator strategy of consumer packaged goods. Let the startups take the existential risk and then buy the survivor. Given BellRing's cash position, their stated TAM expansion, and the upcoming leadership change, an acquisition in an adjacent category like hydration or energy seems highly probable over the next 24 months.
And an acquisition of that scale completely rewrites the investment thesis. It changes the math overnight. Which brings us right back to the core lesson of this deep dive. You cannot trade consumer packaged goods by just skimming the headline revenue beat.
No, you definitely can't.
You have to understand the granular, often messy reality of supply chain logistics. The brutal unit economics of an NCAT display at a club retailer, the global macro dynamics of the whey protein market, and the massive lag effect of omnichannel advertising. The algorithms will react to the 1% growth today, but the true value of the company is hidden in the operational mechanics of tomorrow.
Because the truth is never in the press release. It's always in the supply chain.
Thank you for joining us for this extensive analysis of BellRing Brands. Take this framework, apply it to your own models, keep an eye on that Q2 margin dip, and as always, stay informed and stay profitable.